A CEO earning $5 million per year is actually losing money to expenses most people never see coming. And the research data shows this isn't an anomaly. It's the hidden financial reality facing the highest paid executives in the world's richest countries. Welcome back to Data Fortune Research. We're breaking down one of wealth's greatest paradoxes today: why CEOs at the top of the income ladder report liquidity problems, stress about cash flow, and feel financially trapped despite compensation packages that place them in the top 1% of earners. This isn't about poor spending habits. This is about structural costs embedded into executive life that drain wealth faster than salaries can replace it. Let's start with the numbers that define this trap. According to IRS Statistics of Income data, the top 1% of American household earners make $819,000 annually or more. That's the threshold. Now, for CEOs at Fortune 500 companies, we're talking significantly higher. BLS occupational data shows CEO median compensation at $221,080, but the 90th percentile breaks $500,000, and top earners frequently exceed $5 million. Some earn north of $10 million when equity compensation is included. But here's where the paradox begins. Research shows that a $5 million CEO salary, after taxes, legal fees, security, and lifestyle maintenance in a major metropolitan area, leaves considerably less discretionary wealth than a $300,000 professional earning in a lower tax jurisdiction with lower cost of living structures. Let's quantify the tax burden first, because this is the largest hidden cost. Data from multiple sources indicates that a CEO earning $5 million in gross compensation faces a combined federal and state tax burden between 45% and 52%, depending on location. In California, federal capital gains rates plus state income tax can push effective rates above 50%. In New York, the same scenario creates a similar tax cliff. That means $1 to $6 million of the $5 million vanishes immediately to tax obligations. Now we're left with roughly $4 to $9 million in net income for the year, but the CEO's expenses haven't been paid yet. Here's where our research into executive cost structures reveals the depth of the trap. Executive-level CEOs operating in markets like New York, San Francisco, and Los Angeles face baseline lifestyle and security costs that are fundamentally different from six-figure earners. Consider housing. A CEO maintaining executive presence in Manhattan or the San Francisco Peninsula typically needs a primary residence valued between $3 and $8 million. Property taxes alone in these markets run $40,000 to $120,000 annually. Insurance on a $8 million home in a high-risk area, $15,000 to $40,000 per year. Maintenance and staff, $30,000 to $80,000. That's a single line item expense totaling $85,000 to $240,000 annually for housing alone. But a CEO isn't just one residence. Research on ultra-high net worth individual spending patterns indicates that top executives maintain multiple properties. A winter home in Miami, a mountain retreat, possibly an international property. Aggregate housing costs for $5 million earning CEO in a major market, $250,000 to $400,000 per year across all properties. Next, security and personal safety infrastructure. This is a cost that most earners below the C-suite never encounter. Data on executive security services indicates that publicly traded company CEOs typically maintain personal security personnel, $200,000 to $400,000 annually, home security systems and monitoring, $50,000 to $150,000 per year, executive protection during travel, $100,000 to $300,000 annually, secure transportation, armored vehicles, private security drivers, $150,000 to $350,000 per year, total security infrastructure for a Fortune 500 CEO, $500,000 to $2 million annually. This is not optional. Board liability, public profile, and threat assessment create legal and practical obligations. Then there are liability and insurance costs. Data from executive risk management firms shows that C-suite officers typically carry directors and officers D&O liability insurance, $200,000 to $800,000 annually, executive life insurance often required by boards, $100,000 to $400,000 per year, umbrella liability policies, $50,000 to $200,000 annually. These aren't optional purchases. Board governance requirements and personal asset protection create mandatory insurance overhead that averages $350,000 to $4 million annually. Now add professional fees. CEOs at this income level maintain tax preparation and planning, $50,000 to $150,000 annually legal counsel ongoing retainers, $100,000 to $500,000 per year financial advisory and wealth management, $100,000 to $500,000 annually often 0.5% to 1% of liquid assets accounting and compliance, $50,000 to $200,000 per year professional fees aggregate to $300,000 to $1.35 million annually. Let's add one more category, lifestyle and entertainment expenses required for executive position maintenance. Research indicates CEOs in major markets spend on club memberships, country clubs, business clubs, social clubs, $50,000 to $300,000 annually entertainment and business meals, $100,000 to $300,000 per year charitable giving and foundation management, often required for public profile, $200,000 to $1 million annually travel beyond business, $150,000 to $500,000 per lifestyle maintenance, $500,000 to $1 million annually. Now let's do the math. Our CEO earned $5 million gross. After taxes, $4 to $9 million remaining. After housing costs, $250K, $400K, $2 to $265 million. After security, $500K, $2M, $800K to $15 million. After insurance, $350K, $4M, we're down to $400K or potentially negative. We haven't finished. Professional fees, $300K, $135M, and lifestyle maintenance, $500K, $1M haven't been allocated yet. In a realistic scenario for top CEO in a major market, the full cost structure, taxes, housing, security, insurance, professional fees, and lifestyle consumes between $2, $4 and $4, $2 million of the $5 million gross compensation. That leaves between $800,000 and $2, $6 million for actual savings, investments, or discretionary spending. But research from the Federal Reserve Survey of Consumer Finances shows that top 1% households with net worth above $11.6 million typically spend 60–80% of their liquid income on recurring obligations. The CEO earning $5 million in a high-cost market operates within a financial system where most of their compensation is committed to structural expenses before savings are possible. Compare this to a similarly compensated executive in Austin, Miami, with no state income tax, or Singapore. A $5 million earning CEO in Texas saves 17% in state income tax compared to California. That's $408,500 annually, nearly $500,000 recovered simply by jurisdiction. Housing costs in Austin run 40–50% lower than San Francisco. Security costs scale with threat assessment, often lower in less target-rich environments. The same $5 million salary in a lower tax, lower cost of living region leaves substantially more capital for actual wealth accumulation. This is the hidden financial trap for high-paid CEOs. The salary structure creates the illusion of wealth, but the execution environment, taxes, location, required security, fiduciary obligations, and lifestyle requirements consumes the surplus that high earners expect to accumulate. Further complicating the picture, BLS data on occupational burnout and stress indicates that executives at this compensation level work 60–80-hour weeks, face elevated health and mental health costs due to stress, and often experience shorter career longevity. When you factor in health care costs for high-stress occupations, often $50,000 to $200,000 annually in additional coverage, the financial trap deepens. Research shows that some of the wealthiest CEOs in the world have actually reported lower net worth increases than mid-market executives in lower tax jurisdictions, purely due to structural cost differences. A $3 million earning executive in a 20% state income tax environment can accumulate wealth faster than a $5 million executive in a 13.3% state income tax jurisdiction, when all costs are calculated. This is the paradox data fortune research